All right, financial math classes. We're continuing on with our payroll deductions with state income tax. So every state has different laws with their income tax. Some states don't have income tax, but they all have different tax rates. This is generally what the breakdown. This is the breakdown where your state income tax goes to in California, 26% to K through 12 education, 17% to Medicaid and children's health programs, 17% to higher education, 5% to corrections, 1% public assistance, and 6% transportation. And this big one is all other, 32%. Note the all other includes care for residents with disabilities, pensions, and health benefits for public employees, economic development, environmental projects, state police, parks, recreation, general aid to local governments. So real similar to what the federal income tax goes to, but this is just at the state level. So here in California, here is the income tax brackets for single people, 22 to 23. The problems we'll be doing, we're not going to do this, but these are graduated income tax brackets. So the more money you make, the higher the tax rate goes. But keep in mind, so people down here at the bottom, that's not the actual bottom there. The highest tax rate, 12.3%. So people that make over $677,000 are going to be taxed at this, but it's only the money they make over that amount. So we don't do a lot of this, but it is important to understand. The first, $10,000 you make, you're only taxed at 1%. Every dollar more than that 10,099, every dollar more than that up into the 23,942, that money is taxed at 2%. Not all the money, just the money over $10,099 to 23,942, and then just continues to go up. So even if you get a raise at work and it puts you into a higher tax bracket, not all your money is taxed at that higher bracket. Very important to understand. People go online sound like idiots when they talk about tax brackets because they don't understand them. Make sure you understand not all your money is being taxed at that higher rate, just the money made over a certain amount. So vocab will be doing exemptions. These are withholding allowances, which allow for supporting yourself, your spouse, and others in your family. So let's look at an example here. We have Jack. He earns $30,940 annually. He is married and supports one child. The state tax rate in his state is 4.5% of taxable income. What this means is that taxable income, there's exemptions. So not all that money is taxed. So let's add up his exemptions. So he's married and supports one child. So there's $4,000 here and supports one child. So the exemptions, he gets $4,000 for being married plus another $2,000 for the child. So he has $6,000 in exemptions. So his taxable income would be the 30,940 minus the amount of exemptions. So that comes out to 24,940. So it's just this money that is taxed at the 4.5%. The $6,000 isn't taxed. So don't forget, I'm going to do this off to the side. Your 4.5%, change it to a decimal. All right. And then the income tax, the state income tax, the SIT, SIT, state income tax, you take that taxable income and multiply it 0.045. You multiply it by your percent as a decimal. Very important, percent decimals. That comes out to 24,940 times 0.045. $1,122.30. So that is how much money he pays annually for income tax. Let's do one more problem. We have Carice Johnson earns $34,850 annually as an engineer. She is single and supports her father. That is one. Withholding. State income tax rate is 3%. So first let's figure out her exemptions. So she's single, so $2,000 for being single. Supports her father, so that's one dependent. So she has a total of $4,000 in exemptions. That 3%, real quick, I'm going to convert that to a decimal. That's 0.03. Figure out her taxable income. So you're going to do the 34,850 minus the 4,000. So she gets taxed on 34,000 or $30,850 annually. And then to figure out the state income tax is you're just gonna multiply that by the 3%. So 3% of 30,850 comes out to $925.50. And that will do it for us. So a couple things to remember, add up the exemptions, change the percent to a decimal so you can calculate with it. And then you're only calculating the state income tax based on taxable income. And that will do it.